that are then not tangible. So the new tax rate on that is, and the way the Finance Act is worded, it talks about a rate of tax at 3%. But it's being introduced under Section 12, which is really imposition of installment taxes. So there could be a differing opinions whether the 3% is then a final tax or is it an advanced tax. We're hoping to see guidelines from the Revenue Authority on how they're going to implement this particular tax. And I think key to note there is that how this would work is the marketplace, the off-takers, through how you get your money if you have invested in cryptocurrencies, are the ones that are going to be charged with actually withholding this tax and then remitting it to the Revenue Authority. Now, I think the other challenge is going to be how Revenue Authority is going to partner with these off-takers to see how this tax is going to be implemented. And one of the other critical things is it's the entire amount. So if you have $100 that you've invested in cryptocurrency, and then say it's now $150, the entire amount, if you withdraw it, will be subject to tax at 3%. But the other issue is really if you do part withdrawals, slow and steady, every time you make a withdrawal, this tax would then be subjected. The withdrawal will be subjected to this tax at 3%. The effective date there is 1st September 2023. The other one is a welcome move where they've reduced the rental income tax from 10% to 7.5%. Ideally, if they were to continue collecting taxes, then the government would have considered retaining this. But I think in order to encourage all landlords to declare the tax on rental income, it's now at 7.5%, and that's effective 1st July 2023. One of the really emotive ones was around the e-TIMS compliance. So what the Act says is that now, from a corporation tax perspective, any company procuring services must then have, the supplier must issue an e-TIMS invoice. Now, a myriad of challenges here, because first, for you to qualify for e-TIMS, you should have the VAT threshold is 5 million shillings. But having discussed this with the Revenue Authority and other stakeholders, it appears that the idea for bringing e-TIMS is not only just VAT, but in essence to gather data. So it's likely to see that even suppliers who do not meet the 5 million threshold would then be required to purchase one of these gadgets, just so that even if they do not meet the 5 million threshold, they'll purchase these gadgets and then issue an invoice to their customer using that e-TIMS. So I think this is a very important one, especially for companies procuring services from the MSMEs, where we don't necessarily have an ETR or an e-TIMS invoice. The effective date for that is 1st January 2024, sorry. And if you do not have that e-TIMS, then you'll not be able to take a deduction of that particular expense. The next one, which is really a welcome move, was on club subscriptions. If you do recall, the Act was changed, and last year, both the employee and the employer were being taxed on club subscriptions and entrance fees. So this is a welcome move, 1st July 2023. It's taxable on either the employer or the employee. So it'll be interesting to see how this pans out for clubs in terms of new members. A critical one there is really around the interest restriction. If you do recall how it works currently, and as of 30th of June, how it would work is that it doesn't matter whether you're a local company or you have borrowed local loans or foreign loans, you'll be required to restrict your interest in accordance with the earnings before interest tax, depreciation and amortization, 30% of that. If you have passed that threshold, then you need to disallow over and above that 30% of your EBITDA. So this essentially means that the restricted interest is only applicable on non-resident borrowings. So very important clarification, it does not matter about the shareholding. So you could be a local company, or you could be a non-resident, especially if you're a local company and you borrowed from non-resident sources because maybe the interest rate was cheaper, you'd still fall under the ambient of this particular provision in terms of restricting the interest 30% to your EBITDA. So the next one is really around the members clubs, and this was really a very emotive, provision, whereby now any other income excluding, entrance fees or subscriptions is now going to be chargeable to tax. Remember, the previous provision was 75%. So you take your total income, you do 75% of that. If it falls within the members' fees and subscriptions, then you do not pay tax at all. So it's likely that clubs would now have to segregate the sources of income and then pay tax on the business income, which is now excluding member subscriptions and entrance fee. This is effective 1st July 2023. So another really emotive one was the restriction of offsetting withholding tax, that's already been paid. And putting this into perspective is, especially for multinationals, when they pay management fee or when they pay interest to their related non-resident entity out there, they usually withhold tax. Then when there's an audit done, transfer pricing audit done, maybe Revenue Authority would make an adjustment to that expense and say, the total expense was not, at arm's length, and they would seek to reduce that expense. So what happens there is that in the past, we would argue with the Revenue Authority and say, hey, you already have the withholding tax portion. And now if you're disallowing and I need to pay corporation tax, then I'm only going to pay the differential. But what this provision is saying is that they're going to restrict the offsetting as well as refund. So you're going to get, it actually means that you're not going to get that money back. And the other issue here, it talks about an audit adjustment. So there's no clarification whether that audit adjustment is a revenue audit adjustment or is it going to be an external audit adjustment. So it's very important that taxpayers then take that into consideration and ensure that the transfer pricing policies are in full compliance. You have proper benchmarking to support the arm's length principle, and it is within that arm's length principle to avoid getting stuck between a rock and a hard place. So the effective date for this is 1st September 2023. And Revenue Authority has always, been reluctant to refund that initial withholding tax paid. So it's no surprise that they would amend the law to then bring in this particular provision. Now, from a taxation of branches perspective, remember, a branch is a permanent establishment of, a parent company out there. The current rate is 37.5%, but the new rate is going to be 30%, and that's effective 1st January 2024. While that is a welcome move, I think the issue is now on the new tax that they've introduced on branches, which is on repatriated profits. How this works is that if a branch, makes profits of tax, they're automatically deemed to be repatriated to the head office or the parent company. So now what the law says is that that element that has been deemed to be repatriated is also going to be subject to further tax. And this is really over and above the corporate tax that you've already paid for that financial year. And the formula is really, it's 15% based on that formula, where R is the repatriated profit. And how you arrive at that is that A1 is the opening net assets at the beginning of the year. Then the P is really the net profit for the year. And then you less any tax liability that you shall be paying. So P minus T, and then you then subtract the net assets at the end of the year. So when you do that formula, whatever you arrive would be then the repatriated profit, and that would be subjected to 15%. I think this is a very important one because essentially then the taxation of branches does increase. Now, on the withholding tax, some of the key withholding tax changes, I think this one has been a major one. And if you all recall, the initial stage, the initial finance bill talked about withholding tax being remitted within 24 hours. And the reason why that was done is because Revenue Authority was successful with the betting and gaming sector, which, by the way, is a cash business. And Revenue Authority had interlinked the systems, and they were the ones generating the payment registration numbers so that that tax could then be paid. Now, the challenge we're going to experience here is that the way this has been introduced, under Section 35, which is the section for withholding tax, it actually does retain the element of the earlier of accrual or payment. So when you accrue for an invoice that was subject to withholding tax, then you would need to then pay withholding tax within 5 working days. Working days is Monday to Friday. It does not include weekends, does not include public holidays. So important also to take that into consideration. This is going to be administratively cumbersome, especially for entities that are recipient of a lot of services that are subject to withholding tax. And bringing that again is really around the promotion and advertisement fees, which is also now going to be subject to withholding tax. This has been an issue that the Revenue Authority has argued for many, many years, that advertising, marketing expenses should be subject to withholding tax. But the argument that professionals have always put forward is that, is it technical in nature? That's why it should not be subjected to withholding tax. So they've now brought that into the ambient of withholding tax, and the threshold remains at 24,000, and the resident rate is 5%. The new tax there is really around digital content monetization. And look, this is a good tax. It does expand the tax base so that people who are in this particular line of business then actually would also contribute towards the taxes, tax collections of this country. Now, the challenge here was initially it was at 15%, and the understanding that I think the stakeholders had was that it should have been final tax. But remember, this is actually brought under Section 35, and therefore would be deemed to be an advanced tax. So once the entity receiving the service has withheld the tax and remitted it to KRA, the digital content providers, or influencers as we call them, would then still be subject to pay the 30% end-to-end. So they'll have to account for the remaining 25%. The benefit here is that you can still take into consideration any expenses that you've incurred to then arrive at your adjusted taxable profit. The rate for non-resident is 20%, and this was not initially in the finance bill. It's a new addition as we see it in the Act. Now, from a CGT perspective, a number of changes, and I think I'm going to focus on the last one there. But before I get to that, there has been a change in terms of exemption for reorganization. So the reason here is that you must be part of a group before you can get this CGT exemption. And possibly why they did that is because maybe some companies, they would acquire new companies 100%, maybe to transfer land between one company to the other, and then deem that to be a related party and a group restructure, and therefore not pay CGT. So now, if you do acquire a new company with that in mind, a possible future restructure, then it's important that you consider that you have to have been within that group for at least 2 years before you are able to take this particular advantage of this particular exemption. Now, the complicated one there is really the last one, around indirect transfer of shares, which is now subject to CGT if you can say there's a change in the underlying ownership by more than 20%. And there are two aspects to that. The first one is for really partnerships and trusts. So remember, the income of a trust is exempt. But now what happens is that if the value of the alienating shares or interest is more than 20% of the immovable property, and the definition of immovable property in the Finance Act has also been changed to include, which was really surprising, to include an estate, rights, and they've also talked about debt on mortgage. So that entire definition, it's a very broad definition, would then be the definition of immovable property. So you have to do 20% of that value, and assuming the value is $1 million, so you do 20% of that, you get about $200,000. And if the value of the alienating interests or rights or shares is then, say, $500,000, the essence would be that you pay CGT at 15%. Remember, our neighboring countries, Uganda, Tanzania, actually the CGT rate is 30%, and Rwanda charged 5% on indirect transfers. That's the first tax cut. The second one is really around company restructures. So bear in mind that you have a company incorporated in Kenya, held by, say, another company incorporated maybe in Mauritius, held by 30%. And then the company in Mauritius is held then by an ultimate parent company, say in BVI, 100%. If the company in BVI sells its shares or part of its shares, you have to look at the underlying ownership of the ultimate parent company to that in Kenya. So you do 100 by 30%, the net underlying ownership is then 30%, which is already higher than the 20%. So in that case, CGT would be applicable in Kenya. Now, the question would beg, how would KRA even know that, you've actually made this indirect transfer way out 3 layers above, the income derived in Kenya? We have something called audited financial statements, and ideally auditors are required to, factor in any changes. Then obviously you have the transfer pricing policies that, again, you need to do this, update it on an annual basis. Group reorganizations or restructures would also be captured. So I think where we're going with this is that most group companies would then want to be compliant, and this is from our experience in the region, and would declare this and pay the CGT element that would arise on that. So it's a very important change, the twofold that I've talked about, for companies to then consider, especially multinationals or even family businesses that have holding companies out of the country. I think the one of the part I need to mention is the withholding tax is 5 working days, and that is in line with withholding VAT. So that too, you need to remit within 5 working days upon accrual or payment. Okay. Now, looking at the indirect taxes, there have been a number of changes, and I think the first one there is the most important and well-received, change in legislation, which is really the exportation of taxable services, which is now zero-rated. The history about this, if you recall, is that initially it was zero-rated, moved to exempt, and then because of some certain cases that Revenue Authority lost, we saw a change in legislation to say that they're now VATable. Impacted a number of companies. They talked about BPO, business process outsourcing, being zero-rated. The definition of BPO was not in the VAT Act, but derived from the SEZ Act. So again, those complications did arise. So a very welcome move that now exportation of taxable services are now zero-rated, and this is effective 1st July 2023, and we do hope that now the export of services will take a lot more traction than it did in the last one year. The next one there is really an emotive one, increasing of the fuel prices, the VAT on fuel from 8 to 16%. This too, as you must have seen already on social media, is effective 1st July 2023, and has a major impact, has a ripple impact into the economy. So potentially, not potentially, definitely the price of commodities is going to go up. And when my colleague will come and talk about the other changes, you'll see how even the net income or disposable income of employees is likely to go down. So I think this is going to have a ripple impact into the economy. Whether it was a wise decision or not is yet to be seen. And I have always maintained that increase of taxes does not necessarily translate into increased tax revenue. But let's see how this would play out. Another welcome move from the zero-rating of LPG. I think this is and this is on both the gas and the cylinder. So I think that again would go towards use of cleaner and clean energy. Now, there is an important change in terms of the claiming of input VAT. So now it's important that when you're receiving services, especially if they're within the VAT threshold, then you get ETIMS compliant invoice. So we moved from ETR, then we went to TIMS. Now there is ETIMS. The purpose of getting to ETIMS is really to then fully automate your VAT returns, as happens in the region. So the minute you raise an invoice, then ideally your customer, it should automatically come into the iTax as well. This is something I know the Revenue Authority is working on, and hopefully that would really cure a lot of issues around VAT inconsistencies. But there are challenges around this that we have seen from a regional perspective. So case in point in Tanzania, the gadgets that they use shut off at a certain point, but a business will continue maybe up to midnight. So the businesses and the Revenue Authority are in consistent reconciliations. So I think it's very important that, as taxpayers, we also do think about, technology and think about reconciliation tools so that we do not get into this particular conundrum when it comes. Another one that was welcome was really the refund of tax on bad debts. Remember, the current provision talked about between 3 to 4. Now it's extended to up to 10 years, and this is effective 1st July 2023. So we do, look forward to that as well. And then the issue about VAT registration, especially for digital service providers, I think the challenge was the law was not clear. So a DST provider would say, but I'm not, going to meet that particular threshold. Do I really need to register? So this is essentially just the cleanup to capture all DST entities that would be subject to DST, whether they meet the 5 million shillings or not, they would be required to register for the VAT obligation. And then the record keeping one, again, another cleanup. I think back in the day, maybe 20 years ago, 30 years ago, it was mandatory that you had to have, hard copies of documents and based in Kenya. Now that has since changed, and this is just a basic cleanup that your records could be anywhere, but provided they're availed during an audit. So I think this is a very good one. 1 and 2 that you do not see here is really the transfer for business as a going concern. The initial finance bill had proposed it to be exempt, but then status quo has remained. So whether you transfer within a related entity or to a third party, you would still pay for VAT. And I think the main challenge here is from a capital gains perspective, when you're doing this business reorganization and the ultimate holding is not changing, you do get an exemption. But now, from a VAT perspective, even though the control and the ultimate holding has not changed, and you're just doing a transfer between your group, you'd still pay VAT. And then a good one there was really around the circular economy, the zero waste. There was a proposal in the initial, finance bill that the VAT on importation of plastic equipment and plant and machinery for recycling plastic was going to come back to being VATable. It's currently exempt, so I'm glad to see that at least that has been retained. Now, finally, around excise duty, a number of changes, but the critical ones there. The first one is at least now we'll not have annual inflationary agreements, adjustments. So at least that too is welcome. The next one is really around the betting industry, where they're now required to pay or remit excise duty within 24 hours. It's cash business, so could be, in order for them. And then the issue there is really around manufacturers of alcoholic beverages. Again, they too would need to remit excise duty within 24 hours. Now, the challenge here is that this is not a cash business. So they would have to remit this within 24 hours as they wait for their customers to pay them. And then the introduction of offense to excise stamps, I think, is a welcome move as well, because it will then reduce any illicit products, excisable products in the market, and the penalty there is pretty stiff. Interesting to note is that there is an app that even you and I can download and scan the barcode to see whether that stamp is real or not. So I think that is information that is important to share. So even as you purchase and you consume any excisable product, it's important for you to see, you can check and do a self-check and see whether that is a fake or a real stamp. And then another welcome move in terms of exemption of mobile phone kits. So from excise duty, I think this would then encourage local manufacturing. And there was a change in VAT as well that takes this to now being, not subject to VAT. So I think that in totality should then reduce the price of locally manufactured, mobile phones. Now, interesting changes, is again around imported cement and sugar. Remember, excise duty is a sin tax. So sugar is now, subject to excise duty at a rate of 5 shillings per kg, and then imported cement too is now subject to, excise duty at a rate of 1.5 shillings per kilogram, or 10% of the value. The challenge I foresee there is really around the, housing project. If the local manufacturers are unable to meet the supply, remember we work in a supply and demand economy, then maybe the developers of, certain projects, housing projects, would then be required to import the cement, and now they'll pay that particular excess duty, and that would only mean an increase in the cost of the project. I think that would be the main ones for us to share with the delegates on this call this morning. And with that, I would now like to invite my colleague, Lydia Abala, who will then take us through the Tax Procedures Act and miscellaneous acts. Thank you so much. Do keep your questions coming on the chat box so that we can then answer them as we go along.
Thank you very much, Sandeep, for that thought-provoking session, and good morning to all delegates who have joined us today. It's indeed a pleasure to go through this very important act that affects all our lives, your career, your personal life, your business, in various respects. So it would certainly be interesting to explore and see what tax compliance now looks like from Saturday, from 1st July, when most of these provisions that we are talking about come into force. As introduced, I'm Lydia Bala, and in the next 20 or so minutes, I'll be taking you through the changes introduced to the Tax Procedures Act, the Miscellaneous Fees and Levies Act. I'll also talk about the Tax Appeals Tribunal Act and other attendant acts affecting our fiscal policy in this country. I will start with the good news first. And the first one is the finance bill had previously proposed to introduce a 20% mandatory cash deposit or provision of security of a similar amount for appeals by taxpayers to the High Court. And you will notice that Parliament excluded this proposal from the final act. I must admit that this proposal was strenuously opposed by different stakeholders on the basis that it would amount to gross violation of taxpayers' constitutional right to access to justice, and even your own right to hold property, where you have to now surrender that property to be heard or to have your day in court. Another good news we have around the Tax Procedures Act is the increase in ADR timelines at the tribunal. Previously, there were 90 days. You had 90 days to get into a roundtable discussion with the KRA in an attempt to get into an out-of-court settlement. This has now been increased to 120 days. And the effect of this is that we will now have more time to dispense with issues out of court, which would otherwise revert back to the tribunal or to the higher courts because of lack of time or just want of time, where your time expires just when you're about to conclude. Another change is there's now some amnesty extended on interest, penalties, or fines of unpaid tax. However, this amnesty program has a number of conditions, which I'll explain to you shortly. And before I get into that, it is, however, first very critical that we take note of some 3 very important dates around this amnesty program. And one of them is 31st December 2022. This date is important because this amnesty program now will only apply to penalties, interest, or fines due on tax debt where the full principal tax have been paid before 31st December 2022. Such penalties and interest will be fully waived by operation of this law effective 1st September 2023. The second important date around this amnesty is 30th June 2024. And why this date is important is that where you haven't cleared your principal tax before the due date, the 31st December 2022, you still have an opportunity to apply and be considered under this program. But then you have to finish or complete paying the principal tax by 30th June 2024. You also have to provide a commitment to the Revenue Authority that there'll be no instances of taxes owed or non-compliance on your end. And you also have to go ahead and clear all taxes owed by that 30th June 2024, if at all you are to enjoy this amnesty program. If 30th June reaches and you had been granted an amnesty and you still have some tax balance due, then that tax balance will continue earning interest and penalties post 30th June 2024. The third and final critical dates under this amnesty program is 1st September 2023. And that's where the details are, because this is the effective date of this new change. What this means is that between now and September, KRA still has every legal right to move and collect penalties and interest, even where you've already cleared your principal taxes by December last year. And as you may know, a number of taxpayers in the weeks leading up to this Act received some letters indicating that they have partial waiver of penalties and interest. What I saw were mostly about 40%, and they were given up to 30th June to pay the balance, the 60% balance. With this effective date of 1st September, KRA between 1st July and September will still come in and attempt to collect or enforce that 60% balance before this comes into law. Again, I think it's very important for those who will ultimately benefit on this amnesty program come September, not only to just wait and say it happened by operation of the law. It's also very critical that you go back to your iTax ledger to confirm that indeed your historical penalties, interests, or fines have been cleared. Because then if you say the law came in and it has been fully waived, if it's not reflected in your waiver, in your ledger, then really can you really benefit from it? So this is good news, but it's two-pronged, like I've said. There's that transition period I've talked about that is still, it's not going to come in immediately. And there's also need for those who are looking to benefit to go back to iTax and confirm that indeed any penalties and interests have been vacated. I will not talk much about the change in timelines for remitting withholding VAT, because I think Sandeep very aptly put it when he was speaking about the changes around withholding tax remittance within 5 days. But effectively what this means is that now the cash flows, it's coming from a cash flow need from the government side. Now within 5 days, you'll be required to remit and put in your withholding VAT if you are an appointed withholding VAT agent. Just going back to my previous point on amnesty, one may wonder what happens to taxes that are due post, penalties and interests that are due post 30th June 2024. And what will happen for this is that there's a proposal now to remove the commissioner's powers or discretion to waive penalties and interest after effective 1st July 2023. And this will relate to taxes from January this year going forward. So what this means is that the cost of compliance is now higher. The threshold for compliance is now higher. There's no room for maybe inadvertent errors or even negligence on taxpayers' part. There's need for robust internal controls, continued health checks from a tax perspective, because even a slight human error now may lead a taxpayer to pay now hefty penalties post July 2023, especially for the period starting January this year and going forward. So if you ask me, the amnesty I spoke to in the previous part is just a transition clause that ultimately ends in a hard line of 30th June 2024. And that's why that date is really important if you think about this proposed change. Another good news here, the timelines for processing of refunds have now been revised, and this has taken the form of reduction of the time now that the KRA is required to pay refunds. From the previous 2 years and effective 1st July, this has been reduced to now 6 months. Connected to this, KRA will now be compelled to review taxpayers' refund applications within 120 days. And if they do not do so within the stipulated timelines, then by operation of this change in law, it is taken that they have agreed with you and they've approved that refund application and they actually owe you, in which case then taxpayers have every right to offset outstanding liabilities from past periods or their future tax liabilities against such overpaid taxes and interest thereto. The spirit of this amendment really is just to ensure accountability on the part of KRA and extend some protection to taxpayers from the undue burden of delayed processing of refunds, especially now that VAT is going to be zero rated. Some taxpayers in the export of services business will be at VAT payable position constantly. So this is just to extend that protection in that regard. And while this is a welcome move, a challenge I personally foresee with this change is, as of today, we are not aware whether the government has set aside any funds or a program to honor this new change in law. We are very much alive to the backlog of refunds that have been due over the last few years for most of our clients that we work with. While the refunds have been approved, they are yet to be paid. While there's every intention to be paid, then there's the cash flow aspect on the government's side. So while the 6 months looks good on paper, on the spirit of the law, as to whether this would be honored from a practical perspective remains to be seen. I will now move on to the other acts, and for this I will start with the Miscellaneous Fees and Levies Act. Around this, the biggest change was the introduction of Exports and Investment Promotion Levy. And for this, I know the name can be a bit misleading. This is a levy on goods goods imported into the country, not exports, for home use. And connected to this, a third schedule has been introduced in this act, just to give a breakdown of the goods affected and the attendant rates that would apply. As an example, the things we saw on that list are cement clinkers. Cement clinkers, simply, if I explain it at a very high level, this is a core raw material for the manufacture of cement. It accounts to over 70% of cement, and it comes from limestone. There's also craft paper. We saw in the list in the third schedule, rods of iron and other steel products are now going to be subjected to this levy if you import these goods in the country. Goods imported from any of the East African Community member states will, however, be exempt from this new levy. The introduction of this levy, as you can imagine, is just to protect our local industries and reduce exports to some extent. While this is a commendable move, again, it shall be very interesting to see whether the government will hold the existing local industries accountable from the perspective of good quality products, meeting demand, and just maintaining that competitive edge from a global perspective. So it's a delicate balance. While we want to protect these local industries, there also needs to be mechanism from the government's part to hold the local industries accountable from quality's perspective, and just guard against counterfeit and such things. Also demand, because like I said, cement clinker manufacturers, for example, may only be a handful. Do they have the capacity to meet the demand of the local cement manufacturing industries as we know them? Because then if that demand is not met by operation of the macroeconomics, then the price of cement would ultimately shoot up. And I know Sandeep alluded to the affordable housing levy or scheme, which I'll speak to shortly. Isn't this counteractive from the perspective of, if we want to promote affordable housing, then these products, the iron rods, the cement clinkers, should really be monitored from the perspective of just maintaining competitiveness in terms of cost. Another change in the Miscellaneous and Levies Act is the reduction of export levy on leather and leather products classified under the various codes from 80% to 50% or 0.5 US dollars. And this is just to encourage export of leather and leather products. Again, this is just to open up the leather providers to the global market so that they are able to export more. Well, this is aimed to stimulate that industry. There's also the question as to whether are we promoting local exploitation of leather to come up with finished products, for example. Will we then be exporting all our raw materials, and then companies that maybe need leather to produce finished goods end up with having no supply? So that's a question that also remains to be seen with the reduction of export levy from 80 to 50%. Another change in the Miscellaneous Fees and Levies Act is the reduction of IDF. This is the import declaration fee, and RDL, railway development fee, from 3.5% to 2.5%. Again, this is just to discourage imports that would flood the markets and maybe disadvantage the local industries as we have them here. There's, again, with every change, there are two sides of the coin. There's again a group or a school of thought who do not welcome this move. And these are the manufacturers who previously were enjoying preferential rates of 1.5%. To them, this is an increase, which will ultimately likely increase the cost of finished products in the market, the cost of doing business on their end, and it would ultimately have a ripple effect even to the food on the table of the local mwananchi. Moving away from the Miscellaneous Fees and Levy Act, I want to talk about the issue of affordable housing levy introduced to the Employment Act. Effective 1st July, there'll now be a mandatory levy at the rate of 1.5% deducted on an employee's gross salary. Gross salary in this instance includes your basic salary and all attendant benefits that you have, including bonuses. So that would be captured in the 1.5. And the housing levy is expected to be used exclusively for the housing, for the affordable housing agenda, for financing of the affordable housing agenda. And how this will be administered is just similar to pay, in terms of from next month, employers will now be required alongside pay to deduct this levy and remit by the 9th of the following month. Of course, late payment has some penalties of 2% of the total unpaid tax will be applied accordingly. While this again aims, the spirit of this aims to meet government's commitment to the affordable housing agenda and the Big Four agenda, its imposition again has been met with mixed reactions, because you'll notice it no longer has the 5,000 shillings cap it previously had. And the question around this, the removal of this cap, is whether now everyone who's contributing will now be qualifying for the affordable housing scheme, or will it still result in some inequity? Because if, say, you are earning ₦1 million, your 1.5 is certainly more than the person contributing 1.5 of 100,000 shillings. Is it then that the high income earners are contributing to a scheme that they will not benefit from, and they're even being made to contribute more? That is again a catch-22, where there's two divides who think it's a noble idea, it's going to promote this very critical agenda for this country. But then there's the other agenda, the other divide, who think it may result in some inequity. There's a proposed change to the Special Economic Zones Act, where now the gazetted or the demarcated special economic zones are now open to include both customs and non-customs controlled areas. What this means is that private persons who are not considered as SEZ can now go in and enjoy the infrastructure in these SEZ areas without necessarily benefiting from the preferential rates or being considered SEZ. Again, I believe this is a very good move, effective 1st July, that will just ensure that these SEZ are used optimally and to full capacity, and are just not left out to the exclusion of people who would otherwise need. Another change, and this is to the Kenya Revenue Authority Act. The change around that is that the act has been revised to expand the powers of the KRA board. Currently, the KRA board has powers to appoint commissioners, various departments, domestic taxes, you name it. But now these powers are being extended to even appointment of deputy commissioners. This we expect to just extend what we've seen in the last few months in terms of the KRA board is getting more and more involved in the daily operations of the Revenue Authority. It's now more hands-on. And the converse of this is now the current KRA commissioners will now not be responsible for even appointing their heads of departments, or the CG will no longer be responsible for appointing the deputy commissioners as we had seen in the past. As I conclude, there's also a change in the Export Processing Zones Act, and around this, the Act has included a proviso relating to treatment of goods brought out of the EPZ enterprises of the EPZ zones into the customs territory. Customs territory in this context are the EAC, into the EAC member states, including DRC now. And the amendment provides that goods which originate from the customs territory will now be exempt from payment of import duty. And where such goods are only partly from the EAC member state and there's a component that are not from the member states, then that component that does not originate from the East African community will certainly be still subject to import duty. Without a doubt, this is, again, not a conversation for 1 hour. This is something that is going to affect us on an ongoing basis. And as I've mentioned, the cost and the threshold for compliance has now just moved to a next level. And from tomorrow, we'll be interested to just see what this looks like for all of us as advisors, as various tax managers in our various entities, as leaders, as business owners, as employees. It changes from tomorrow. And without a doubt, even on the government's perspective, the government will certainly be judged based on how well this act will be implemented. Because like I've said, the spirit of the law is one thing, and the practicalities of it is a totally different thing. As I end this session, I would like to invite our partner, Clive Akora, who will take a few questions from this meeting and close today's webinar. Thank you.
Thank you, Lydia, and thank you, Sandeep, for that presentation, which has gone very well in terms of enlightening us on the key changes, most of which are due to take effect from tomorrow, others on 1st September, and others on 1st January. And one of the things that for sure, from the discussion that we have had before when we presented the finance bill and today, is that this Finance Act is one of the most extensive, and it's not possible within the 1 hour that we have today to cover all the issues that are covered in that Finance Act. And what we've done today is just to highlight the key changes, but it will be important for you to go through the entire Finance Act. We will be sharing our analysis of the Finance Act with a comprehensive analysis of the changes, including those that we may not have touched on today. Now, for our participants, you're encouraged to have your questions on the chat, and we'll pick a few of those. And I've got a few questions that have come through already, which I will try to go through. I know today is 30th. There's a deadline on filing returns that is due. So we'll try to release you early so that you can also ensure that you fulfill that important requirement, because like Lydia said, the commissioner's rights for waiver of penalties and interest has been removed. And if you don't file your returns on time, then you're likely to be faced with penalties and interest. So the first question that has come through is, do we have a structure and guideline on the filing of returns and payment of the housing levy, which, as Lydia said, is taking effect from 1st July 2023. That is tomorrow, but the payments will be due by the 9th of August for the first payment for the month of July. So for this particular one, there are no guidelines as yet. We still don't know whether the carrier will be given the right to collect, or employers will be asked to pay the amounts directly to the housing fund. So we are hoping that within the month of July, before the amount becomes due, before employers are required to deduct the amount, the guidelines will be issued and they'll be issued in time so that for those who need to change their payroll systems to accommodate the tax, they'll have the opportunity to do so in good time. So we wait, and if you tune in to our various communications, then we will be communicating either on Twitter, tax alerts, in terms of the guidelines that will be issued on the implementation of the housing levy. The other question that has come through is kindly elaborate on the 16% insurance tax, and that is from a VAT perspective. And in the discussions with stakeholders for purposes of the finance bill, this was one of those heated questions that was asked. What is it that we are aiming to tax? Are we taxing people who, for instance, get into an accident, they get paid? Is the carrier seeking to tax those people? So the right answer is that's not the case. The specific supplies that are affected are taxable supplies. And there are two specific provisions on that particular Finance Act relating to this change. The first one says, where you receive insurance compensation for taxable supplies, and that insurance compensation includes VAT, then you are required to pay that VAT to the government, which is well and good, because in that particular instance, the insurance company has paid you the VAT. So it's in order, if you get the VAT from the insurance company, then you remit it. But the problem is in those particular instances where the insurance company only compensates you for the cost of the supplies without VAT. Because in those particular instances, what the government is saying is that you should consider the compensation to be VAT inclusive and therefore compute VAT and remit the VAT to the government. Now, the industry practice is that insurance does not pay the VAT on insured supplies. And that is where the problem is because in those particular instances, which is possibly in all the cases, then the taxpayers will be out of pocket to the tune of the VAT that they'll remit to the government, which they'll not have received from insurance companies. So possibly one way of going around this is to have discussions with the insurance companies to ensure that the VAT is also covered in the compensation, but that will also mean that the premiums for insurance are likely to increase. The other question that has come through is on the amnesty. And especially in those particular instances where for debts incurred up to 31st December 2022, where the taxpayers had not paid the amount due and they're supposed to apply to the KRA for the amnesty. And part of the conditions include ensuring that the taxpayers pay the tax amount due by 30th June 2024. And one of the unclear ones is where it says that they do not incur further tax, and also that they sign a commitment that they pay all the taxes due. And the question that's coming through is, what exactly does this mean? So in these particular instances where the taxpayers have not paid tax to the revenue authority and they're applying to the amnesty, the law says that you can only make one application. And my thoughts around this is that what the KRA is trying to do is to ensure that when the taxpayer is making the application, they make a comprehensive application covering all the possible tax areas that they may have incurred. And that once you made that application, you cannot go back and say, I applied, I forgot. So probably I applied on income tax, I forgot VAT. Now I'm coming back to apply again. You're supposed to make one application. That application needs to be comprehensive, because if it's not comprehensive, then there's a danger that you may not get that particular amnesty. So for those particular instances, it may be important to do a comprehensive review of your transaction, just to ensure that when you make the application is comprehensive and covers everything. The other question that has come through is the issue around the waiver of penalties and interest in those particular instances where taxpayers had paid the principal tax. And the context for the questions coming through is in those particular instances where for some taxpayers, the KRA has written to them, giving them a percentage waiver. So for instance, if you had paid the principal tax and applied for waiver of penalties and interest, there have been cases where the KRA writes to the taxpayer and says, we waived 50%. Can you pay 50%? You'll only receive the 50% waiver on condition that you make the payment by 30th June 2023, which is today midnight. And the question is, given that there's this law that is giving a full 100% amnesty, what am I to do in those instances where the KRA has decided to give a partial waiver of penalties and interest? So it's a tricky situation where for taxpayers, we need to make a decision, make a business commercial decision, because the provision for 100% waiver takes effect from 1st September 2023. Now, the deadline that the KRA has given for persons who are given partial waivers to pay the tax is today, which essentially means that from 1st July to 1st September, those particular taxpayers are exposed. There's nothing that prevents the KRA from going ahead and possibly issuing agency notices to recover the taxes due on those particular waivers. So it's very important that for taxpayers in those circumstances, consider the position and consider whether it makes sense to then settle the tax liabilities that have been indicated. Now, the other things that we'd like to cover is on the changes to the PAYE rates. You know, again, with effect from 1st July 2023, there's going to be changes to the PAYE rates for people earning above 500,000, where income between 500,000 and 800,000 will be subject to tax at the rate of 32.5%, and income above 800,000 will be subject to tax at 35%. I think most of the conversations that we have had have sort of been on the basis that the people likely to be affected by these are the people who are employed, and that's not the case. This is a specific change to the individual PAYE bands, which essentially means that anybody receiving income, if you're a sole proprietor, if you're operating in a partnership, and you pay tax based on the individual PAYE bands, then you will be affected by this particular change. So it's important to take that into consideration. And also for purposes of those who are planning on the system changes, PAYE changes, you need to change your payroll system to reflect the new rates, to reflect the housing levy, to be critical to consider that and that take that into effect. I think the one issue that has risen is that if you are operating as a sole proprietor, if you're operating as a partnership, then this particular change sort of puts you at a disadvantage, especially where your competitors are operating as companies, because for them, they'll continue to pay tax at 30%, while then for sole proprietors, they'll be paying tax at 35%. So it may be a position where you then think about your operating model. Do you want to incorporate if you're operating as a sole proprietor, or if you're in a partnership and you have got the opportunity to sort of change your structure? I know there are people, for instance, the auditors who are unable to change this because of the requirements in terms of how they can operate. So if I speak, I try to see any additional changes, comments. I see is the 1.5% housing levy on gross salary deducted before calculation of PAYE the same way NSSF deductions are handled? And the confirmation is that the 1.5% will apply on the gross. There was a comment by the chair of the finance committee that if they applied it on the basic, that people would then try to tax plan around it and pay more of their income in bonuses and stuff, and effectively reduce the amount payable. So there are all those kinds of conversations going on around this particular issue. So just going through the questions, my colleagues are answering a number of the questions online through the chat. And we will be sharing a recording of this particular conversation together with our finance analysis, which is important. So like I mentioned, today is the last day for tax returns. So it's important that we give you back some time to essentially prepare the tax returns. So I will quickly move to the conclusion in terms of the closing remarks for this particular session. I think for me, the important thing is that the Finance Act is here with us. Over the last few months, we've gone through the public participation. We've made our views known about the various provisions that were introduced. The National Assembly has gone through the public comments, they've made a decision, and we have the act with us today. And for us now is to make a choice. And really, we don't have much of a choice in most of these particular instances. We do need to commence the journey of implementation. So just to be sure, the specific issues around housing levy, 1st July, increase of PAYE rates, 1st July, turnover tax, 1st July. And then while most people have looked at the Finance Act, including the very sort of onerous provisions that it's brought, there are some winners in this particular process. For instance, the persons earning residential income tax, their rate has gone down. The exportation of services, it's zero rated. That's been a big concern. Importers, the railway development levy, IDL has gone down. The issues around the waiver of penalties and interest, persons operating in special economic zones, all those, they've got something to smile, even though for most people, the finance bill, the Finance Act comes with a number of sort of onerous responsibilities for people. So for me, to everyone, please read the Finance Act, internalize, and start the implementation process. As KPMG, we are available to, again, work with you on the journey. We'll prepare the analysis and send it across to you. If you need to speak to anyone, speak to your usual advisors at KPMG, and we'll help you with the implementation. So I do wish you well. I wish you a good weekend ahead, and all the best until we meet again in other forums. So thank you all. And